What if the home you worked your entire life to pay off, the house where you raised your children, made your memories, and planned your retirement, could be affected by a new government tax rule that most Canadian seniors have never even heard of? What if the Canada Revenue Agency had the ability to assess your property in a way that directly reduces the money you have set aside for your golden years? That is not a what if anymore. In 2026, the CRA has introduced and is now enforcing a property-related rule that is quietly catching seniors off guard across this country. And if you own a home, a cottage, a rental property, or any real estate, you need to understand this rule right now, because the financial impact could be significant, and once it affects you, reversing it is not easy. Stay with me through this entire video. Do not skip ahead, because I am going to explain this clearly, simply, and honestly. And I am also going to walk you through the latest updates to your CPP, OAS, and GIS for 2026, so you have the full picture of what is happening with your money this year. Welcome back to Mr. Jack, the channel that exists for one reason and one reason only: to make sure Canadian seniors have the accurate, clear, and timely information they need to protect their money, their rights, and their future. I am glad you found this video today, because the topic we are covering is one that affects a very large number of Canadian seniors, particularly homeowners and retirees who have built their financial security around real estate. Today, we are going to talk about the new 2026 CRA property rule, what it is, how it works, who it affects, and what you should do to protect yourself and your assets. This is not a topic that gets talked about enough, and that is exactly why we are covering it here. We are also going to walk through the most important 2026 updates to the Canada Pension Plan, Old Age Security, and the Guaranteed Income Supplement, three pillars of retirement income for millions of Canadian seniors. By the end of this video, you will have a clear and complete picture of where things stand in 2026 and what steps you need to take. Let us start with the subject that brought you to this video: the new CRA property rule. Now, before we go any further, let me be completely clear about one thing. The Canada Revenue Agency does not simply take your home away. What we are talking about here is a rule that affects how certain property transactions and property-related income are assessed for tax purposes. And for seniors who are not aware of this rule, the financial consequences can feel very much like losing a significant piece of their nest egg. The rule in question relates to the CRA's expanded enforcement of the principal residence exemption, combined with tightened reporting requirements for property sales and real estate transactions involving seniors and retirees. Here is what this means in plain language. For many years, Canadians have benefited from what is known as the principal residence exemption. This is the rule that allows you to sell your primary home without paying capital gains tax on the profit. If you bought your home decades ago for a much lower price and you sell it today for a significantly higher amount, the principal residence exemption has traditionally protected most or all of that profit from being taxed. However, the CRA has been increasing its scrutiny of how Canadians report property sales, and in 2026, this scrutiny has intensified even further. There are now stricter reporting rules in place that require every Canadian who sells a property, including their principal residence, to report that sale on their annual tax return. This has been a requirement since 2016, but the enforcement and the penalties for non-compliance have become significantly stronger in 2026. If you sell your home and do not properly report the sale on your tax return, even if the full gain is exempt under the principal residence exemption, the CRA can deny your exemption entirely. That means the entire capital gain from the sale of your home could become taxable. For a senior who has owned their home for 30 or 40 years and has seen its value increase by several $100,000, this could result in a tax bill of tens of thousands of dollars or more. That is the core of the rule. It is about reporting. It is about making sure that when you sell a property, you are filling you. Now let us talk about why this matters so deeply to Canadian seniors specifically, and why the phrase nest egg is exactly the right way to think about this issue. For the majority of Canadian seniors, the family home is not just a place to live. It is the single largest financial asset they own. Many seniors have little to no savings in registered accounts like RRSPs or TFSAs. Many do not have employer pension plans beyond CPP. The equity in their home, the value of their property minus any mortgage they still owe, is often the primary source of financial security they have built over a lifetime of work. When seniors reach their 60s, 70s, or 80s, many of them begin to think about what to do with that home equity. Some choose to downsize, to sell a large family home and move to a smaller, more manageable property, using the proceeds to fund their retirement. Some choose to sell their home and move in with family or into a senior's residence. Some sell a cottage or investment property to supplement their retirement income. In all of these scenarios, the tax treatment of the property sale is critically important. If the principal residence exemption is properly claimed, the entire profit from the sale may be tax-free. But if the exemption is not reported correctly, or if the property does not fully qualify for the exemption, the financial impact can dramatically reduce the amount of money the senior receives from the sale. Imagine a senior who sells their family home of 35 years for $700,000. They originally paid $150,000 for it. The capital gain is $550,000. If the principal residence exemption fully applies and is properly reported, that entire $550,000 gain is tax-free. But if the CRA denies the exemption due to improper reporting, 50% of that gain, $275,000, becomes taxable income. At a modest marginal tax rate of 30%, that is a tax bill of $82,500. That is a significant portion of a senior's nest egg, gone, simply because the right box was not checked on the right form. This is not a hypothetical. This is happening to Canadian seniors right now. And in 2026, with the CRA's increased enforcement activity, the number of affected seniors is growing. So what do you do to protect yourself? The answer is straightforward. Report every property sale on your tax return in the year the sale occurs. Work with a tax professional who understands the principal residence exemption rules. Keep records of when you purchased your property, how much you paid, what improvements you made, and when you sold it. Do not assume anything is automatic. Do not assume your real estate agent or lawyer has filed anything with the CRA on your behalf. They have not. The responsibility for reporting the sale on your tax return is yours alone. Now let us move into the CPP, OAS, and GIS updates for 2026, because these are equally important for every Canadian senior watching this video. The Canada Pension Plan is the foundation of retirement income for the majority of working Canadians. If you worked in Canada and contributed to CPP during your career, you are entitled to receive monthly CPP retirement benefits. The amount you receive depends on how much you contributed and for how long, as well as the age at which you choose to start receiving benefits. For 2026, the CPP has seen its annual cost of living increase applied to all current recipients. This increase is tied to the Consumer Price Index and is designed to help your CPP payment keep pace with inflation. If you are already receiving CPP, you will have noticed that your January 2026 payment was slightly higher than your December 2025 payment. This increase was automatic and required no action on your part. The maximum monthly CPP retirement benefit for a new recipient starting at age 65 in 2026 has increased as well, reflecting both the indexation adjustment and the ongoing impact of the CPP enhancement program that began in 2019. This enhancement has been gradually increasing both contribution rates for workers and the eventual benefit amounts for future retirees. For those of you who are not yet receiving CPP, the timing of when you start your benefit is one of the most important financial decisions you will make in retirement. If you start CPP at age 60, your monthly benefit is permanently reduced by 0.6% for every month before your 65th birthday. Starting at 60 means a reduction of 36% compared to what you would receive at 65. On the other hand, if you delay starting CPP past your 65th birthday, your benefit increases by 0.7% for every month of delay, up to a maximum increase of 42% if you wait until you are 70. In 2026, with benefit amounts higher than they have ever been, the financial advantage of delaying CPP is more meaningful than in previous years. A decision to wait even 2 or 3 additional years before starting your CPP can result in hundreds of extra dollars per month for the rest of your life. The 2026 CPP payment dates are as follows: January 29th, February 26th, March 27th, April 28th, May 28th, June 26th, July 29th, August 27th, September 25th, October 29th, November 26th, and December 22nd. These are the standard payment dates for the year. If your regular payment date falls on a weekend or statutory holiday, payment will typically arrive on the last business day before that date. Old Age Security is Canada's universal retirement pension, available to all Canadians who meet the age and residency requirements, regardless of their work history or contributions. To receive OAS, you must be at least 65 years of age and have lived in Canada for a minimum of 10 years after the age of 18. To receive the full OAS benefit, you generally need 40 years of Canadian residency after turning 18. If you have fewer than 40 years of residency, you will receive a partial OAS payment calculated proportionally. For 2026, OAS payments have been adjusted upward through the quarterly indexation process. The government reviews the Consumer Price Index every 3 months, in January, April, July, and October, and adjusts OAS payments accordingly. This means that your OAS payment can increase up to 4 times per year, depending on inflation trends. One of the most significant OAS features currently in effect is the permanent 10% increase for seniors aged 75 and older. This enhancement was introduced to recognize that older seniors face higher costs in areas like healthcare, home care, and assisted living. If you are 75 or older, your OAS payment is automatically 10% higher than the standard amount. You do not need to apply for this increase. It is applied automatically when you reach age 75. The OAS Clawback, formerly called the OAS Recovery Tax, is a rule that reduces your OAS payments if your annual net income exceeds a certain threshold. For 2026, this threshold has been adjusted slightly upward as part of the annual tax system updates. If your income is above the threshold, you will be required to repay a portion of your OAS through your annual income tax return at a rate of 15 cents for every dollar above the threshold. For seniors who have significant income from investments, rental properties, registered accounts, or other pension sources, the OAS clawback is something to watch carefully in 2026. This is especially relevant given the CRA property rule we discussed earlier. If you sell a property in 2026 and that sale generates taxable capital gains income, that increase in your net income could push you over the OAS clawback threshold, resulting in a reduction of your OAS payment for the following year. This is a real and direct connection between the CRA property rule and your OAS benefit. It is one more reason why planning your property transactions carefully and understanding the tax consequences in advance is so important. OAS payment dates for 2026 are the same as CPP: January 29th, February 26th, March 27th, April 28th, May 28th, June 26th, July 29th, August 27th, September 25th, October 29th, November 26th, and December 22nd. If you have not yet applied for OAS and you are approaching age 65, remember that in many cases you will need to apply manually. Service Canada will sometimes send an automatic enrollment letter, but this does not always happen, particularly if you have a complex residency history or have lived outside Canada for extended periods. Apply at least 6 months before your 65th birthday to ensure your first payment arrives on time. The Guaranteed Income Supplement is a non-taxable monthly benefit paid to low-income seniors who are already receiving OAS and who live in Canada. It is one of the most valuable programs available to seniors with limited income, and yet it remains one of the most underutilized, simply because many eligible seniors do not know they qualify. For 2026, GIS payment amounts have been increased through the same quarterly indexation process that applies to OAS. If you are currently receiving GIS, your payments are higher now than they were at the start of 2025, and they will continue to be adjusted each quarter based on inflation. The GIS is income tested, which means the amount you receive depends on your annual income from the previous year. The less income you have outside of your OAS payment, the higher your GIS will be. For single seniors with very little other income, the GIS can add several $100s per month to their total benefit, a meaningful amount that can make a real difference in daily life. However, and this is critically important, the GIS requires you to file your income tax return every single year without exception. The GIS is not automatically renewed. Each year, Service Canada uses your previous year's tax return to assess your income and determine your GIS eligibility and payment amount. If you do not file your taxes by the April 30th deadline, your GIS payments can be suspended for a period of up to 12 months, from July of that year through to the following June. For 2026, The April 30th tax filing deadline is on a Wednesday. There are no extensions for most people. If you are a GIS recipient, missing this deadline is one of the most costly mistakes you can make. 12 months of missed GIS payments can add up to thousands of dollars, money that you may never be able to fully recover. If you need help filing your taxes and cannot afford a professional tax preparer, free tax clinics are available through the Community Volunteer Income Tax Program administered by the Canada Revenue Agency. These clinics are offered at libraries, community centers, seniors centers, and many other locations across Canada each spring. They are completely free and are staffed by trained volunteers who specialize in helping seniors with simple to moderate tax situations. Now here is the important connection between GIS and the CRA property rule we discussed earlier. The GIS is reduced by 50 cents for every dollar of non-OAS income you receive. This means that if you sell a property in 2026 and that sale generates taxable income, whether capital gains, rental income, or business income from a property flip, that income will be counted in your GIS calculation for the following year. Depending on the amount, it could significantly reduce or even eliminate your GIS for the period from July 2027 onward. This is another reason why understanding the tax consequences of your property decisions is so important. A poorly planned property sale can affect not just your immediate tax bill, but also your GIS for an entire year. For seniors who are considering selling a property in 2026, we strongly encourage you to speak with a tax professional before finalizing the sale, not just to ensure proper reporting, but to understand the full downstream impact on your OAS, your GIS, and your overall retirement income picture. The GIS also has a residency requirement. If you are absent from Canada for more than 6 consecutive months, your GIS payments will stop and will only resume once you have returned and re-established your residency. This rule applies regardless of whether you are a Canadian citizen, a permanent resident, or a dual citizen. For seniors who were not aware of this rule and who have been spending extended time outside Canada, this is an important flag. If your GIS has been interrupted due to an extended absence, contact Service Canada to understand your options for reinstating your payments. Now let us step back and look at the big picture. What do all of these updates mean together for the average Canadian senior in 2026? For a senior who owns a home, receives CPP, OAS, and GIS, and is planning to sell their property sometime in the next few years, 2026 is a year that demands attention and planning. The CRA property rule means that any property transaction you make this year must be reported correctly and completely. The stakes of non-compliance are higher than they have ever been, and the financial consequences, a large unexpected tax bill, a denial of the principal residence exemption, or a spike in taxable income that reduces your GIS and triggers the OAS clawback, can significantly erode the value of the nest egg you have built over a lifetime. On the positive side, the 2026 increases to CPP, OAS, and GIS mean that your monthly government income is higher this year than it was in 2025. The cost of living adjustments, while they do not solve every financial challenge seniors face, do help protect the real value of your benefits against inflation. And for seniors who may not be receiving all of the benefits they are entitled to, whether because they have not applied for GIS, have not yet enrolled in OAS, or have not looked into retroactive back payments, 2026 is a year to take action. Every dollar of benefit income you are entitled to but not receiving is a dollar that belongs to you. The connection between your property decisions and your benefit income is one of the least understood aspects of retirement planning in Canada. Many seniors think of their home and their CPP and OAS as completely separate parts of their finances, but in 2026, they are more connected than ever. Through the CRA's reporting requirements, through the OAS clawback, and through the GIS income test. Understanding these connections and planning around them is what separates seniors who protect their nest egg from those who lose part of it unnecessarily. We are now at the critical alerts section. Please listen carefully to each one of these points, write them down if you can, and share this video with any senior you know who owns property or is receiving government benefits. Alert number 1. If you sold a property in 2025 or plan to sell one in 2026, you must report that sale on your income tax return, even if you believe the full gain is covered by the principal residence exemption. Failure to report can result in the CRA denying your exemption entirely and issuing a large tax assessment. Do not skip this step. Alert number 2. If you have owned a property for less than 365 days before selling it, the profit from that sale may be treated as fully taxable business income under the CRA's property flipping rule. This applies even to your primary residence in most cases. Consult a tax professional before selling any property you have not owned for at least 1 year. Alert number 3. If you earn rental income from any property, a room in your home, a basement suite, a cottage, or a separate investment property, that income must be reported to the CRA. In 2026, the CRA has increased its ability to identify unreported rental income through data sharing agreements. Unreported income can result in back taxes, interest, and penalties. Alert number 4. If you are a GIS recipient, file your 2025 income tax return by April 30th, 2026 without fail. Missing this deadline can suspend your GIS for up to 12 months. Free tax clinics are available across Canada. Contact your local library or community center to find one near you. Alert number 5. If you sell a property in 2026 and it generates a taxable capital gain, be aware that this additional income may push you above the OAS clawback threshold, reducing your OAS payment for the 2027 payment period. Plan your property transactions with the full tax picture in mind, not just the sale price. Alert number 6. If you are receiving GIS and you plan to be outside Canada for more than 6 consecutive months, your GIS payments will stop. Contact Service Canada before you travel so you understand exactly how your absence will affect your benefits. Alert number 7. If you are approaching age 65 in 2026, apply for OAS and assess your GIS eligibility now, at least 6 months before your birthday. Do not wait for an automatic enrollment letter that may never arrive. Apply proactively through My Service Canada account online or by calling 1-800-277-9914. Alert number 8. If you are already receiving OAS and CPP but have never applied for GIS, check your eligibility today. The GIS is available to low and modest income seniors, is completely non-taxable, and can add hundreds of dollars per month to your retirement income. Many seniors who qualify never apply simply because they do not know it exists. We have covered a tremendous amount of important ground in today's video, and I want to take a few moments to bring it all together clearly before we close. In 2026, the CRA is enforcing stricter reporting rules around property sales, rental income, and the principal residence exemption. For Canadian seniors whose primary financial asset is their home or their real estate, this is not an abstract government issue. It is a direct threat to the nest egg they have spent decades building. The solution is not complicated, but it requires awareness and action. Report every property sale. Work with a qualified tax professional. Keep your records organized. Do not assume your exemption applies automatically without proper reporting. At the same time, your CPP, OAS, and GIS benefits have all been adjusted upward for 2026, and each of these programs has rules and deadlines that require your attention. For GIS recipients, the April 30th tax filing deadline is the most urgent action item right now. For seniors approaching 65, applying early for OAS and GIS can mean the difference between receiving your full entitlement and leaving money on the table. For dual citizens, for property owners, for seniors with rental income, and for everyone who depends on government benefits to fund their retirement, 2026 is a year that rewards those who are informed and prepared. The decisions you make this year about your property, your taxes, and your benefit applications will have consequences that last for years. Protect yourself by staying informed. Protect yourself by taking action. And protect yourself by making sure you have the right advice from the right professionals. That is exactly what Mr. Jack is here to help you do. Every week we bring you the most important updates, explained in plain and simple language so that you always know where you stand and what you need to do next. If you found this video helpful today, please take 1 second and give it a thumbs up. It makes a genuine difference in helping other Canadian seniors find this information when they need it. If you are not yet subscribed to Mr. Jack, please click that subscribe button right now and turn on your notifications. We post new videos every week covering CPP, OAS, GIS, tax tips, housing rules, government benefit changes, and everything else that matters to Canadian seniors. Leave your questions in the comment section below. We read every single comment, and the questions you ask help shape the topics we cover in future videos. If you have a question about the CRA property rule, about your CPP or OAS, or about anything else related to your retirement income, leave it below and we will do our best to address it. And please, share this video. Send it to a neighbor, a friend, a sibling, or a parent who owns property or receives government benefits. You could be saving them from a very expensive mistake simply by sharing what you learned today. Thank you so much for spending this time with me. I am Mr. Jack, and I will see you in the next video. Take care of yourself, protect your nest egg, and stay informed.